Welcome to BTV's Market Insights. Today I'm here with Ryan Irvine. It's a nice check-in. Hi Ryan, nice to see you again.
Nice to see you again as well.
Well, Ryan is with keystocks.com and they are independent research on small cap, dividend, and US stocks. Tell us a little bit more about your company and why investors should be aware and perhaps even subscribing to your newsletter.
Well, we've been around for 23 years. We started in the small cap arena where we thought we could do our research and add value by finding companies that are just overlooked. We went into dividend stocks. We cover all roughly 400 in Canada, look for growth at a reasonable price, sticking with our criteria. Then we expanded into the US. We also cover around 3,000 smaller cap companies in the US where we can add value by really digging into these companies, going into the numbers, interviewing management teams. And what we try to do for our clients is build a simple 15 to 25 stock portfolio consisting of a blend of those three areas: Canadian small caps, Canadian dividend paying stocks, and US stocks to add growth to the portfolio and diversification over the long term. So we tell them what to buy, when to buy, and they use a discount brokerage and build that simple 15 to 25 stock portfolio.
So crazy times in the markets. What's your thoughts on overall on what's happening right now?
The markets on a psychological basis always have this pendulum. It swings to euphoric levels, swings back in the other directions. So if you look at the NASDAQ 100 technology, down 35% from highs, but that really hides the story because 50% of the NASDAQ is down around 55% right now. So what we get from our clients today is, are we now at historical buying opportunities? Is there a generational buying opportunity?
Is this the dip? Yeah.
Exactly. Or have, where have we gone on that pendulum? Did we swing up here? Have we come to equal, or have we gone into a territory where we're finding extreme value? We like to use price to cash flow, but many of these companies, if you look back 10 years, didn't have cash flow, so the numbers aren't as relevant, so we had to use a price to sales. We're at 9 times today. The high was 15.6, so we've come down significantly, but if we look at the 10-year average, it's 8.
Okay.
So I said we're at 9 today, come down from 15.6. So we've kind of come to this point in the middle. Put that next to the entire market. The price to sales on the entire S&P 500 is 2.4. We haven't swung the pendulum back to that area where we see extreme value. When we looked at the companies in that, we took about 55 companies out of that SaaS technology sector in the US. There was about 3 companies right now that we thought were in buy range. We like Microsoft, have owned it for years. We like Alphabet, have owned it for years as well. A new company that we added is Box Inc. It's a content sharing platform. It's not growing at a massive rate, but we expect revenues to be up 15%, cash flow to be 25% plus, and it trades at around 12 times cash flow, which with cash in the balance sheet, growing at a rate in terms of its revenues above the multiple you're paying and cash flow above the multiple you're paying. So that offers us growth at a reasonable price.
So what would you say overall to investors right now? Start buying, wait a little bit?
You're never going to time the exact bottom. So we even said in a company like Box Inc., if we think the markets can have a better entry point over the next year, let's buy 25% right now of that position. And then let's add in this quality company. If we're wrong and the markets go straight up from here, we've got a 25% position in a really good company. If the markets go a little lower, you can average down. So you're getting into that good company because we're really looking at where's this business going to be 3 to 5 years from now. But we'd like to have an effective entry point. We think it's good, decent value right now. It could be great value at some point over the next year, and we'll add more.
Well, our viewers, they want to know some of your picks. So what are some folks that are on your radar right now and why?
Well, let me tell you, why you should listen to us. The last time we were on, we picked 3 stocks, okay? Dynacor was a company, right? Can I tell you that? This is a company that we liked then at $1.50. We still like it today at $2.90. The business model is very simple. We expect them to expand out of Peru. This company has $27 million in cash in the bank, 87 cents per share. It's guiding for around 15% in terms of revenue growth this year. Earnings far above that.
Yeah.
Dynacor trades at 7 times earnings, not adjusted earnings. If you take out the cash flow or the cash on the balance sheet, it's 5 times earnings. and you're getting growth and you're getting a dividend. The other companies we talked about, Polaris, renewable energy stock, Latin America, it was $10.68 the last time we're on. It's $20.93 today. Why we like dividends? It paid us $1.20 in dividends over that time. So that's 107% return from the last time we talked. It's a name we like. The last company was Biomed.
Yeah.
It was about $8.90 then. It's $9.36 today. Gained around 35% in the last 2 weeks. Why? Because, well, they are a durable medical equipment provider. I think right now they're around fair value, but their organic growth levels are getting back up to 25% where they were historically. Calian Group, now it's $61, but it is a small cap in the Canadian market, $695 million market cap. What we like diversified businesses with good balance sheets right now. They're diversified 4 areas: advanced technology, health, learning, IT, and cyber solutions. So the growthiest area of the business is IT and cybersecurity solutions. Just pick up an acquisition here that adds a significant growth element this year. Like, it's $1.3 billion backlog over a 10-year period. So small cap with a backlog that huge is great.
Yeah.
We expect EBITDA growth this year north of 20%. So you're paying 11.5 for a company that's growing at 20%. We like that, growth at a reasonable price. Hammond Power Solutions, this is a really obscure business. It's been around for 100 years. For example, Hammond's transformers are used at all of Tesla's charging stations across Canada. So it's a nuts and bolts play for us on general electrification of the world. Almost 60% growth in revenue to 127 million. Net earnings were up 272% to 72 cents per share from 19 in the same period last year.
That's crazy.
Huge growth. Unless the economy enters into a massive recession, could earn around $2 per share this year. So based on 9 times that, it's about an $18 fair value, and the company's just completely uncovered in the market, just, you know, like we like it. So
yeah, okay, excellent. We do have time for one more quick pick. Go ahead.
You know, if we want to look to the US, there's a company called Bowman Group, Consulting Group. It's an engineering firm, has a good balance sheet, growing by acquisition. It's a company right now that is completely underfollowed, trades at $11, and it's a good solid company, which we think has growth plans or growth ahead of it built in that the market is not recognizing.
Okay, excellent. There are some awesome picks for you guys, and final words for our investors about what they should be thinking about doing right now in this time of the market. Go ahead.
Yeah, I think it's all about being disciplined, sticking to a criteria. We stick to a criteria, want good businesses with cash flow that trade at reasonable to cheap prices. Then it's even difficult to continue to beat the market over time, but you have to have that strategy. Buy 15 to 25 quality stocks. Don't be seduced by the flavor of the day, no matter how tempting it may sound. And, you know, even a great business, if purchased at an unreasonable price, can lose you money over time. So you need value and growth, but you can't just pay anything for a stock. And we're learning that, and people learned a hard lesson over the past year, buying tech at any price. We're going to have some opportunities to buy some great tech over the next year. Let's wait till they trade at the more reasonable end of the range. And I think we've come on the pendulum to here. We're going to go a little farther here. Let's buy them when they're here.
Okay, excellent. We've had Ryan Irvine from keystocks.com. Don't forget to check them out. You can subscribe to their newsletter. And as Ryan said, start layering now. Thank you, Ryan.
Thank you very much, Taylor. Great to see you.
You too.